Hi, I'm Rand Westlund with the next installment in our series, The Quest for Normalcy. For this webcast, the title of each slide is the name of a song from the past few decades. While we are unable to play excerpts of the music, consider the title and perhaps you can guess the performer. The list of songs and performers will be given at the end of our presentation. Surprisingly enough, I think you'll find the songs affirm the ideas illustrated by the charts. So, to begin, we have titled this episode, Feelin' All Right. One of our staff members asked why we didn't use the song Feeling Groovy. Although that song title might draw a bigger laugh, the song Feelin' All Right is a more apt description of the present economic environment. Not everything is grand, not everything is great, not everything is groovy, but we think the tone and trends in the current data should make us feel all right. Early last year, we focused on the potential change from answering the question, what if something goes wrong, to answering the question, what if something goes right? We then addressed the return of confidence and its effect on decision-making and new activity. But looking back, it seems our question was premature. Multiple setbacks dogged us. Traumatic weather events, Mideast unrest, and government fights bogged everyone down. Attention stayed on recession and anything else that could go wrong. In particular, headlines swirled around government debt, budget troubles, constraints policymakers face, and stresses in the financial system. While various global monetary actions undergird the financial system, the fiscal challenges remain. Summer's clash of the Congress set up the all-star contest of the Congressional Supercommittee, which ended in a 0-0 tie. But what was to be expected in the face of the new election year? Solutions vary because preferred paths vary. Should we have more or less government, and who pays for it? To that end, consider this chart of the 2011 federal budget, titled Meet Me Halfway. The left stack shows the major categories of government spending, while the right stack shows the sum of monies needed to cover that stack, with the dotted box representing the deficit, i.e. the shortfall that needs to be borrowed. No particular box in the left stack will cover the shortfall. Further, significant portions of the left stack, for example, Social Security and Medicare/Medicaid, are like exponential functions, as the program formulas cause the dollars committed to them to grow at an increasing rate. So, if the solution to the shortfall must come from spending, then multiple areas must be included and the growth rates must be reduced. If the solution is to come from the right stack, higher tax rates and/or lower deductions seem the obvious choices. Though Congress argued its way into a 2-month extension of the status quo just ahead of the holidays, the fiscal policy debate we elected in 2010 will continue through 2012 and beyond. So we leave you with the question, meet me halfway? Our next chart, Searchin' So Long, addresses the stress the job market has been under for a period of years. On this graph, the unemployment rate and the job openings rate are compared. The recession caused the unemployment rate to rise and the job openings rate to fall. Since the extremes, these measures have begun to move toward each other as more employers look for people even as they hire more workers. But note that in 2006 and 2007, the job openings rate was higher than current levels as employers could not find people with the skills needed to fill open positions. This dynamic reflects the changing nature of our economy. Though the recession exaggerated these effects, we are headed in the right direction as payroll growth has returned. Employers still seek people with those new sets of skills, and the unemployed still seek those jobs for the skills they have. This map colors Kiplinger's view of 2012's expected dispersion of job growth, an indicator that the mismatch will take more time to resolve and the searching will go on. Our next chart, Working for a Living, traces the index of aggregate weekly payrolls, a measure which calculates the product of the number of employed times average hourly wages times average work week. This index has entered new territory in the aftermath of the recession, reflecting a broader base of available income in the overall consumer group. While this line graph does not represent the experience of every participant in our economy, it represents the sum of the experiences in the private economy. Though various commentators may decry the lack of progress in any given sub-element of this index, we believe this aggregate measure explains why consumer spending continues to post positive numbers, letting consumers pay down debt and slowly add to savings as more are working for a living. Turning to investment markets, our next chart, Riding the Storm Out, shows the change in interest rates over the past year. Note how almost all yields have declined from 12/31/10 to 12/31/11. Fixed income investors sought a place to hide to ride out the turmoil, starting with government securities, but gradually broadening to most categories of fixed income. Lows in U.S. Treasury yields continued to reflect Federal Reserve intentions and the flight to quality prompted by continuing euro worries. Consequently, the positives of the underlying economic improvements have yet to show in the fixed income markets, even as loans and leases return to growth territory. With the Fed's newest commitment to try to hold rates down even longer than before, the income stream across the fixed income arena is extraordinarily low, offering little comfort from the storm. Our next chart, stuck in the middle with you, highlights the optical illusion created by the path the S&P 500 stock index traced out last year. Although the year produced the feeling of a volatile lost cause, as the year closed, we found ourselves back where we started, stuck in the middle of the range of prices. More importantly, however much commentary and feelings may focus on price movements, we want to remind you to focus on the value creation that is evident in so many enterprises, leading to new highs in earnings and more potential benefits to investors. Our final chart, You Can't Always Get What You Want, gives historic context for our emphasis throughout 2011 on collecting income streams from dividend-paying companies. On the far right, see that the heralded 10% long-term return of the stock market includes a hefty share of income. Over the very long term, dividends have been a significant part of investment returns. But until more recent days, they lost favor in the eyes of most investors. Investing for equity income has received renewed attention of late, given low interest rates and slow growth expectations. This should not be viewed as a fad. Rather, it is a return to the basics of investing. Focused corporate managements in a broad range of industries are rewarding investors by increasing dividends, repaying debt, and repurchasing shares. Though the payout levels have yet to catch up with historical highs, the dollars paid out and the yield are climbing. As companies share more with their shareholder owners, the outcome may not give investors what they want, but perhaps we'll get what we need as we move one step closer toward normalcy. Thanks for listening in, and have a great day.